Alright, in this video I wanted to cover IRS Form 8288. This is a form that is filed when you as a buyer purchase real estate that is owned by a non-U.S. person. So if you're a buyer of a piece of real property in the United States and the seller on the other end of this thing is not a U.S. person, which is quite common these days, you as the buyer are going to be obligated under the tax code to withhold tax on the sale of that property, file this form, and then pay the withholding tax to the IRS. Now, this rule exists because under the Internal Revenue Tax Code, the sale of U.S. property by a foreign person is subject to tax, right? It's U.S. source, effectively connected income. But most foreign persons don't have to file tax returns, so in order to make sure the IRS gets their cut of the money, you as the buyer have to do this. So in this example, we have, this is a real estate investment partnership. So it's an LLC filing a Form 1065 every year, so it's a real estate partnership based out of Florida, and they are buying a piece of property that's owned by an individual who lives in Germany. But this guy bought the property in Orlando. He used it as a vacation home. So how do you fill this out and when do you fill it out? The entity that's buying the property needs to fill this out, mail it to the IRS, and pay the tax within 20 days of the sale date. Okay, so let's just run through the form, the withholding piece that needs to go with it, and then we'll look at some of the Internal Revenue Code sections as well. So part one, pretty straightforward, right? We have the name of the buyer or the person that's responsible for withholding. So if in this situation it was just a pure cash deal, the LLC is just buying it directly from the seller. If you're using a bank or a title company or there's a broker involved, then maybe that party might be the one doing this. But in this case, the buyer himself or itself, the LLC, is going to be filing it. So the name of the company, the EIN for the company, phone number, and then in part two or part one, line item 2, describe the property that's being purchased, right? So this is a single family home in Orlando, Florida. Date of transfer, so June 1st, 2020. And then 8288A, that is the withholding slip that's also being filed with the IRS, and a copy is going to the seller. So the amount of forms we're attaching here are just one. You could have multiple properties, or, well, you'd have multiple 8288As if you had joint owners, right? But in this case, it's just being owned by one person, so he's the only seller. In part one, line item 5 here, the amount of the sale proceeds that's subject to withholding tax. So the purchase price of the property was $650,000, and it's subject to a 15% rate. The 15% rate is the new one within the last few years. The base rate used to be 10, but now it's 15%. And then the amount of tax withhold, 15% times $650,000, right? That's the amount of withholding. Now you'll see here, the amount of withholding is on the gross proceeds, right? So the amount of tax that's being withheld and computed on the gross proceeds, you're not really computing what the gain is for the seller on this. The seller might have only bought the property for $640,000 and they're turning it around and selling it for $650,000, only a $10,000 gain. But the amount of tax that has to be withheld is on the gross sale price. So very, very important for foreign sellers to be mindful of these rules. I very seldom recommend foreign sellers actually buy U.S. real property directly for this reason. So when you go to sell it, you could be in quite some trouble here trying to get this money back. Okay, so part 2. This is a different section of the IRC covering withholding obligations. This, for purposes of this example, this does not apply here, so you can leave part 2 blank. And then it's signed, dated, and mailed in to the IRS. Now the 8288A we have up here, this is the withholding slip that evidences which seller is subject to the withholding tax. So withholding agent is the LLC, date of transfer, amount of tax that's being withheld, amount realized in box 3, and the EIN for the LLC up here. Now, ID number for the foreign person. If this is a foreign person that doesn't have an SSN, they don't have an ITIN, or it's a foreign entity that doesn't have an EIN, you just enter foreign U.S. So foreign U.S. is a placeholder used to label individuals that don't have any of those tax ID numbers, or an entity that doesn't have a U.S. tax ID number. So in this case, we have Peter, Germany. He's a German citizen and tax resident, so we just enter foreign U.S. And then we have Peter's foreign address in Berlin where he lives. Box 5, description of the property that was transferred. Again, that should be the same address that was listed on the 8288 above. And then the type of entity subject to withholding. In this case, it's an individual. The reason why it's important to distinguish between individual or corps is corporations often are subject to lower rates. And if it's a corporate entity, you do have to enter here the amount of gain recognized by the foreign corp, right? In this case, it's an individual, so we're just checking the individual box. So that's pretty straightforward how the forms are filled out. There are some exceptions to withholding, which we'll run through really quickly here. So this is IRC Section 1445. This is the code section that covers the withholding tax obligation when you sell real property. So we have the general rule up there that says, the transferee, if the foreign person sells the property, the transferee, so that's the person buying the property, might be required to withhold and deduct tax at 15%, right? But like anything else, there's always exceptions to the rule. One of the big ones I see often is this one, subparagraph 5, a residence where the amount realized does not exceed $300,000 in gross sale proceeds. So if you are buying a property, so let's say you're an individual and you're buying a property directly and you're going to live in it, it's your home. If you're going to use the property as a residence and the amount realized on the sale of the property does not exceed $300,000, then you don't have to go through this process of withholding tax on the sale to that foreign seller. So it is kind of like a de minimis exception and for stated use of the property if it's going to be your personal residence. In this case, obviously the property is sold for over $300,000, but it's also being acquired by an entity. So this is an investment entity that's not going to use it for their personal residence. They're going to rent it out to tenants on Airbnb or something like that. So that exception wouldn't apply here. But okay, so that covers it. Everything I wanted to address on this form. If you have any questions, please leave me a comment below. Happy to answer those. And I look forward to seeing you again soon. Thank you.